And good afternoon to all of our friends and clients in the East, and good morning to all our friends and clients in the West. This is Larry Shavaro, Executive Vice President of First Associates Loan Servicing. And we welcome everybody to our sixth webinar in our successful alternative lending strategy webinar series. Today we have some really important content. Backup Servicing 2.0, key elements for today's lenders regarding all of the news around marketplace lending, and which is near and dear to many of the folks' hearts over here on our webinar. We having folks still dial in and attend, so I'll just go through a couple quick bits of information today. We have David Johnson, the CEO of First Associates, who's going to take us through a very quick presentation, followed by question and answer session. So if you do have questions, please use the chat function on the bottom left. We'll compile the questions, and we will have time for a few questions. The ones we do not get to on the webinar today, we will send them out, and we'll answer them and send them out to all of the folks who have registered and have attended the webinar. In addition, any of the slides that we provide today will be available via an email at the end of the day on today's webinar. We're going to have about a 10 or 12-minute quick presentation followed by the Q&A. What I would like to do before we start is talk about some of the upcoming events that you'll see First Associates in at the next few months. Next week in New York, I will be speaking at the AltLend Summit. David Johnson will be heading to China to speak at Lend It China in another 2 weeks. We have the California Hedge Fund Association's private event at the Del Mar Racetrack. We have a webinar talking about primary servicing for the FinTech industry on August 3rd. Another consumer finance professionals meet up in Carlsbad, California in September, and the California Financial Association, followed by two really good events, the American Banker Marketplace Lending and Investing event in New York, which drew about 800 people last year, and Lend 360, which is an absolute must for folks in the marketplace lending space this year, moving from Atlanta to Chicago. Next slide, please. Who is First Associates? Many folks do know who we are, but for the few that do not, First Associates is the largest third-party marketplace lending servicer in the U.S. We work with many of the major participants and some of the smaller folks, whether in a primary servicing or backup servicing role. We also provide custodial services and contract verification services. Proud to say that in March we had our 30th anniversary, and the mayor of San Diego proclaimed March 2nd as First Associates Day in San Diego. We have about 180 employees in 2 locations here. Next slide, please. These are just some of our clients that we work with. Sometimes we can't get everybody on here, but mostly all of the players in the marketplace space, as well as all of the hedge funds and investment banks that participate in there. And we are the primary servicer for Yamaha's captive finance program. It's my pleasure to introduce David Johnson. David is the CEO of First Associates, who's going to share his thoughts about typical structures of backup servicing and how that's evolving today in marketplace lending. So I will turn it over to David.
Thank you, Larry. It's an interesting and timely topic to talk about backup servicing. As we've all seen the events of the last roughly 4 to 6 months, really I placed my personal time marker on the ABS West event, and we've all seen the trickle of bad news that's come out since then and the resulting circumstances in the market. Prior to that, especially in the run-up to the end of last year, most of the conversation about backup servicing revolved around how do I get in place so I can get more funding for my loan origination startup. And the tone of that has very much changed now. Now it's very much a matter of, is my backup servicing bolted down? What would happen in the case of a trigger event? How does backup servicing even work? It's a fairly esoteric topic. Not that many people really understand the nuts and bolts of it. we have gotten an absolute flood of inquiries about backup servicing from both current clients and also from potential clients who want to understand on a more detailed basis how backup servicing works, what would happen in the case of a trigger event, and exactly how it should be structured in such a way that it makes sense for the particular circumstances that they're in. So I'll start out with some just basic structures. There's often quite a bit of confusion about these, so I'll go through them. Next slide, please. There's generally, and I'll make this somewhat generic so it's easy to understand, but generally there's 4 players in any of these backup structures, or up to 4 players, I should say. There is the lender, who you see on the bottom, the company actually lending consumers or small businesses. There's the backup servicer, First Associates. There is often a loan buyer. So if the lender, in this case, say it's Prosper, the loan buyer might be Garrison. Then there's a leverage provider who, say, is, let's assume that it's Cap One or Cap Source, but they would be providing leverage to the loan buyer to buy those loans from the lender. Alternatively, the leverage provider might be providing leverage directly to the lender where they're using that leverage to make consumer loans or small business loans. And the most simple structure for backup servicing is a 2-party agreement where First Associates will agree to back up that lender who's making the loans to the consumers or small businesses. Usually this is the case with a startup or a very small lender who doesn't yet have any significant institutional financing. As companies grow, the structures change and they become more complicated. And the reason that this structure exists is simply so that usually the lender will use this so they can raise debt capital and say, we do have backup servicing in the case of a trigger event, here's how it would play out, and then the potential loan buyer or the potential leverage provider can feel comfortable knowing that there is coverage. Next slide, please. As the relationships become somewhat more complicated, additional parties come into the backup servicing structure. So in this example, say we have the lender is originating loans and the loan buyer is buying them. Very simple. So in this case, we would want to have a 3-party agreement where all 3 of those parties are party to the backup agreement. And the reason for that is this. In a 2-party structure, in an example like this, the loan buyer has no authority to actually trigger the backup. They may have many clauses about covenants that can be breached or situations that can be rolled on in the actual purchase agreement, but they won't be on in a 2-party agreement, the backup servicing agreement, and therefore they won't be able to trigger it. There was a case in Texas, it was about 9 months ago, of a company that had exactly this issue, and this is one of the reasons why certainly in the marketplace you'll hear us talking about this structure a lot, where there was a 2-party agreement in place, but there was also a leverage provider who was providing leverage on that balance sheet portfolio. The company went into bankruptcy, yet the leverage provider had no authority to actually trigger the backup servicer. So then it sat in bankruptcy, and it's still there actually. If there's a leverage provider or a loan buyer in place, it's important to have all 3 parties on the agreement such that those parties have the authority to trigger the event and to actually have the backup servicer take over. Next slide, please. And then, of course, in many instances, the loan buyer may be getting leverage from the leverage provider, in which case we'll want to have a 4-party agreement in place wherein the loan buyer or the leverage provider can pull the trigger and have the event actually take place. And those are the 3 basic forms of backup servicing structures. As the back end of the loan origination company or the lender gets more complicated, so do the backup servicing structures. And in general, the general rule of thumb would be that for the lender, any entity that has a servicing agreement with the lender should have a backup servicing agreement with First Associates as well. And that backup servicing agreement should include the entities who need to have the right to trigger those agreements. So I'm sure there'll be some questions on that later, but I'd like to move on to how you think about backup servicing what elements in a backup servicer are important, and just what are some of the conversation pieces that should be had around these situations when you're talking about getting a new backup servicer or simply reviewing your own situation to see if backup servicing looks like it's complete. Next slide, please. So here's a relatively short list. And some of this is in a client private note that we had sent out to a few of our clients earlier in the year. So apologies if you've heard of some of this before. But when thinking about a backup servicer, first on the list will be asset experience. So, and this is pretty straightforward. You do not want to hire someone to backup service your portfolio if they don't have experience in that asset class. When a backup servicing trigger event happens, it is not like it is today. It is not a situation where all is well and things are normal and you have plenty of time. There's always something bad happening. Otherwise, there would be no trigger event, obviously. So you don't want someone who's going to be learning on the job in your portfolio. For this, so you've got companies that are focused on cards in the market who occasionally try and do backup servicing for other asset classes. You've got companies who do small business who are trying to, go over to consumer servicing. But if you really have a small business portfolio, that's fine. Or if you really have a card portfolio, that's fine. But you should make sure that whoever your backup servicer is, whether it's First Associates or somebody else, the asset that you're actually producing is something that they currently cover and it's right in their wheelhouse. Not something they do as a hobby, not something that's just a fringe, but is in their core business. Otherwise, you're essentially hiring a plumber to fix your air conditioning at a time when you really need it quite badly. So that would be one. The next issue that I would tag onto would be scalability. I think it's fairly obvious that the ability to scale quickly is key to being a successful backup servicer. For a servicer to absorb an additional portfolio is an event that requires them to grow, and it requires additional software configurations. It includes additional people in seats managing those consumers. So you have to ask yourself, what is the nature of the company and how scalable is it? Companies that are SaaS-based, cloud-based platforms like First Associates can scale up quite quickly. Companies that have proprietary software systems and have kind of more of a fixed basis type of mentality are much harder to scale up. First Associates has spent quite a bit of time working on our scalability. We are all SaaS, all cloud-based. So from that point of view, we are almost infinitely scalable very quickly, which has been great. It's also an issue about where your labor pools are and how much space you have. So we've developed a business architecture where we have a foot in two very strong labor pools, San Diego and Baja California, Tijuana specifically. San Diego is the 8th largest city in the country, and Tijuana is approximately the same size as San Diego. Both have very strong call center industries, and so it's great for our company to have that type of labor availability, and it adds a lot to the scalability. The resources are available. Sometimes you will see other companies, and if they're based in a small town or if they're based in an area of the country where there's not a strong call center industry, that can be a real issue when it comes to scaling up. It can be very difficult to get an entire class of agents on board in an environment like that. I would also talk about risk management would be my next topic. On risk management, I think that there is, sometimes we hear in the marketplace, and I think there is definitely sometimes a belief that there are companies who, will simply take the check for backup servicing every month and then pray that nothing ever happens. And you really want a backup servicer who actively plans and is ready for a backup servicing event. Obviously, you need to have the systems in place. They need to be scalable. You need to have a labor pool. You also need to have the space, physical space as well as labor pool and software space. But in terms of risk management, there's also the issue of just putting butts in seats and putting the right butts in seats. And part of that can be done through a labor pool. Part of that can be done through additional space. But it's also important to view it as somewhat of a reinsurance question. So First Associates was the first, and to my knowledge is still the only, who takes a reinsurance approach to a lot of our backup servicing. With our larger relationships, because obviously this doesn't work with smaller ones, but with our larger relationships, we have reinsurance in place where what I mean by that is, for example, if a company were to trigger a backup event, we would simply take over that company's outsourced resources or their outsourced partners or some of their insourced resources, depending on what their structures are. In the classic case of a large marketplace platform where they're using outsourced collection agencies to do first-party collections, we will have in place for our core partners joinders where we simply take over those contracts. So when you think about the need to get experienced people in seats servicing clients, we're able to do that instantaneously because we can simply take over those contracts. And that's a concept that doesn't really come out in a lot of the backup servicing discussions that happen at conferences and in the general marketplace, but is an important one, and it requires a level of trust and a level of interaction between the backup servicer and the lender that you generally don't see in most backup servicing arrangements. But it is absolutely key to making sure that when a backup servicing event happens, that there's enough risk management there, that the risk truly is mitigated because you have those people in place. And sometimes these companies are just so large that you can't simply expect to scale up overnight. You need to have the resources in place. Next, I would talk about response time. And this plays very much into issues around scalability as well. I think we all know that some of the old legacy servicers, they simply take a long time to board a portfolio. First associates can board a portfolio extremely rapidly. We recently took on the Vouch portfolio. That's a good example of the first marketplace company to really have a backup servicing event. There was a 30-day trigger in the contract. We took it over in 8 business days. The ability to move quickly is key. And when you're dealing with legacy servicers, you often find that they'll have a window that's not open for 90 days or 60 days or some very long period of time that's dependent on either their software provider or it's dependent on their own internal bureaucracies. But they simply can't do it, and that's just not appropriate. It's not adequate. You need to make sure that your response time is going to be something that is appropriate when you have an emergency. You don't want to call 911 and have nobody answer the phone. Next, I'll touch on institutional relationships. One of the ways to shorten the response time is to simply have good relationships. So when there's a backup servicing event that is going to happen, and we've handled 4 or 5 of these in the last 18 months, it's never a surprise to us. And, of course, we don't know exactly how it plays out in other companies' scenarios, but for us, we always get a good long heads up about when something's going to happen. There's trouble in paradise. People know it. The telltale signs start to come out. And so we have a good ramp up to that. And then we also find ourselves constantly working with companies that know us. We know them. We've worked together before. And that allows us to proceed with a level of trust and a level of speed, which is just not possible with someone who is not familiar to the institutions. And I sense that I'm running a little bit over, so I will just touch on compliance and say that in the compliance section, you want your backup servicer to be compliant as a servicer. If it's only ever going to be a backup servicer, PII is only the ever issue. But your backup servicer one day may be your servicer, and you want to make sure that they are compliant with the entire alphabet soup of compliance issues, which is a much different level than just being compliant as a backup servicer. So those are the key 6 issues that I would tick off when thinking about backup servicing. Those structures I mentioned at the beginning, it's key to make sure that you have the right structure in place. And I think it's very important that when you're talking with your backup servicer, that you make sure that you have a structure which is appropriate for your company and not just a generic type of backup servicing that some company is willing to put on there for you. And that's it, and I'll hand it back to Larry for Q&A.
And thanks, David. That was some really good insight around backup servicing. As you know, we have seen and have heard from all of the rating agencies and top investment banks and credit funds around this issue, and we thought that the information today would be invaluable to many of these folks. And we do have a whole bunch of questions here. And so the first question was, we understand that First Associates also provides a lot of primary servicing for marketplace lenders. What is the difference in the model that you're providing versus a typical lending club or Prosper's model?
Okay, good question. Lending Club and Prosper both use outsourced first-party collection agencies to call on delinquent accounts. So an account will go 15 to 30 days delinquent, and that will get shifted over to a collection agency to make a call and try and bring that account back into current. That's a very different model than what we do at First Associates. We service the accounts from cradle to grave. As soon as it's originated, it comes onto our system. We welcome those borrowers with, letters, emails, texts, calls, whatever is appropriate. And then during the relationship of that loan, we are constantly in contact with those borrowers throughout the loan. It's not a kind of one-off call when they're delinquent, and it's not a kind of here's a call now when you're delinquent, here's a call from a different collection agency later on when you're delinquent. It is a continuous relationship with the borrower that results in a high level of service and therefore borrower satisfaction and much more effectiveness on the actual delinquency management piece.
Okay, thank you for that. We have another question. What would happen if, with all of the noise around Lending Club, what would happen if Lending Club went out of business tomorrow?
Well, there would certainly be a lot of consternation in the marketplace, that's for sure, if Lending Club went out of business tomorrow. First I'll say that we certainly don't expect Lending Club to go out of business tomorrow. It is a public company, and I think there's lots of information available about Lending Club. In the case of something like a Lending Club going out of business tomorrow, we have a number of backup servicing contracts with individual loan buyers associated with Lending Club, so people who are buying Lending Club loans. We would take over all of those loans and we would begin servicing them. And that is a pretty standard process for us, as you can imagine from our last discussion, but we have plans in place to do that. So we would pull out the pieces that we backup service, and then the rest of it would be subject to whatever backup arrangements they might have at the time. But we certainly would take our piece and begin servicing that immediately. For Lending Club and for all the large players, we have the information come to us daily, including the ACH information. So in the case of a very short response time disaster, we have the ability to actually run the notch files and begin collecting consumer payments immediately. So the actual flip over is quite short and is quite efficient in that case. We can begin servicing those loans in as little as 5 days, which is just about enough time to notify the consumers of a change in servicing.
Okay, thank you for that. And our last question, and although the question does ask about what the recent delinquency was on the vouch portfolio, I'll kind of, that is something that we can't provide due to confidentiality, but we can provide a question that maybe I'll ask David around that. So when there is a trigger event, do you expect a rise in delinquency when you trigger or convert the portfolio, and then how do you change that to get the portfolio performing again?
It's really situation dependent on that one. With vouch, I should say with a situation like vouch where things were going fairly normally until the actual end, then there'll be a small temporary bump in delinquency as you'll get a lot of people, especially on a smaller portfolio, who will call up and say, hey, I read that vouch is out of business. Who are you? And why do I need to pay you? And in that case, it's a matter of doing debt validation with all the consumers, getting them on board. It's basically a small hiccup in what is otherwise a pretty smooth process, is that understanding that even though vouch is gone, everything continues as it was. And that's really driven a lot of times, especially in that instance, by it being a very small Silicon Valley focused type of event where everybody knows everything that's going on. It's kind of an anomaly. But other than that, it's very business as usual. You would expect that delinquencies would go down over the kind of short to medium to longer term, just because we're providing a little more servicing oomph to it than was being applied. In the case of other events, where you have, say, for instance, we took a subprime auto lender over last September, and the portfolio was about 13,000 loans, almost entirely delinquent. Delinquent loans were in 90% of the portfolio, and we managed to pull off a huge and significant downward trend in delinquencies. And that's because you had a whole legions of mad consumers, you had angry regulators, you had all these things, and the portfolio was just not being serviced adequately. And so the level of service that we're providing just drove delinquencies way down, because it was very different what they had been providing in the past. And incidentally, that is more the standard case where there is a regulatory shutdown, where there's an abrupt end, where there's some kind of event where that generates some either ill will among consumers, or it generates just a very bad servicing regimen. And then as that is cured, delinquency goes down.
Okay, and so thank you for that. We are out of time. We did get a few more questions, so we will provide some answers and send that out. Please look for a survey at the end today. We would appreciate that. Take a minute to fill out your comments. It helps us as we develop additional content for more webinars. And we look forward to seeing you on our next webinar and some of the events upcoming this fall. Have a great day, and thanks for dialing in and listening to our webinar series today. Have a great day.